Well, good morning, everyone. I'm Don McMahon with FlyCloud Consulting. I will be your host today of all the hosts. I have some distinguished guest speakers with me. Stephen Dobro with Primark Benefits, retirement plan expert who will tell you about all the retirement stuff you had no idea about.
Hi, I'm Stephen Dobro, president of Primark Benefits. Primark Benefits is a pension consulting firm, third-party administration for retirement plans. We take care of retirement plans of all types, and we do fiduciary outsourcing. We also have a great reputation for fixing plans that are in trouble. So if you run into problems, we're the people to call. We've been doing this since 1971 with 30 employees and about 700 or 800 clients. We're a lot more than an 800 number. While the whole industry has gone to robots and 800 numbers that don't ever get answered, we have people, and they're going to actually ask you your questions and get to the bottom of it and do a really good job of giving you the right answer the first time, and that makes us somewhat unique in our industry. I've been the owner of Primark Benefits since 1990. After starting there in 1976, I've got a lot of designations. And I've had the honor of being president of the pension industry and testifying before Congress and working with government officials to work on pension policy in the United States. We got a couple laws and pension change after I testified. Last summer, I was testifying before the Department of Labor on 401k plan audits, for example. And, I regularly meet with senators, congressmen, officials of the IRS and Treasury and all that kind of thing. So there's a lot of different kinds of plans. As I mentioned before, there are 24 different types of plans, and some are based on IRAs, and some are based, are called defined contribution plans, like your 401ks, your 403bs, your 457s, your profit sharing, that kind of thing. Then there's the old granddaddy of plans or pension plans where you might receive a monthly pension when you're retired. So instead of getting a salary from an employer, you get a salary from the plan after you've retired. We do all those types of plans too. Now, one of the biggest things that we look at here is that, when there is a retirement plan at work, people save. And in fact, if people left to save on their own, an average American working class person, about 5% or less will save into an IRA if they don't have a plan at work. But if they're offered a plan, 71% of them will actually save. And this is really important because what happens is the only money in America really is in retirement plans. Now you have some money in your house. And so really about, 2/3 of your money is, tied up. But we find that when people get divorced, the only money they have to split up, the only cash is what's in their retirement plan. And the reason why I bring this up now is because what happens when you have a global pandemic and people get laid off and now everybody's scrambling for money? Where is the only money they can have? Well, it's actually in the retirement plan. So a lot of things were done with Congress and the industry to make sure that we address these issues. And the things I want to talk about today are how panic did not set in, even though we got really prepared for it. And we created all kinds of new kinds of distribution and loan offerings so people could have access to their money. We've delayed money coming into plans. We've people who were required to take money out while the stock market was down. We kind of found a way to mitigate that problem. And then we became very involved in this Paycheck Protection Program, which many of you have taken advantage of. And retirement expenses are part of what gets forgiven. So that's very important. And then I also want to make sure that no one misses their deadlines on what's going on. So as we fell into this pandemic thing and people got laid off by their employer because many of them were scared off by the government's desire to have people go on paid family leave and that kind of thing, we were surprised. We prepared ourselves to become a retirement deaccumulation company instead of a retirement accumulation company. And, it's kind of funny. There was no real run on the bank. People, even when the stock market went down, people didn't panic. We got very few calls from people who said, I just saw my account go down by 40%. I'm really worried if it's ever going to come back up. And it did come back up. It came back up in a pretty big hurry. And you didn't have to wait years like you did in the 2008 crisis. So there was no panic, and I'm frankly very surprised. Now, many employers expanded their loan programs so that people could borrow more money for their retirement plan and have better access to it. Many employers also increased their distribution options so that people could access that money if they needed it, because everyone was erring on the side of let's have people pay their rent and buy their food. That's the more immediate need. So what we found was only a small number of participants actually got more loans and actually got more distributions. So we're really kind of like flummoxed by that. Now, there are new kinds of coronavirus loans and distributions. Plans have to be modified in order to make all these things be true, but some of you have IRAs and the distributions apply to those too. But, who is a qualified individual is something the government said, well, okay, if the plan sponsors so agree, we're going to let people access this funds if they, for example, test positive for the coronavirus, or maybe their spouse or dependents test positive, or maybe they've been furloughed, or maybe they've been quarantined, or maybe they've had reduced hours, or maybe they've lost their childcare, or maybe they've had a reduction in pay, a reduction in hours, or any kind of circumstances that were easy bar to, in fact, they expanded it after a while to say anybody in your household has any of this long list of things, you have the right, if your plan so allows, to go in and grab some money. So the first thing they did was, normally in a retirement plan, the most you can borrow out is $50,000 or half your balance. Well, the first thing Congress did was said, okay, well, now you can take up to 100,000 or 100% of your balance if your plan so allows. And of course, if it's a loan, you have to pay yourself back, but you're paying your own account back. And if you have other loans outstanding, you have a chance to change the amortization schedule. So you don't have to pay loan payments the rest of the year, because we know you're laid off or furloughed or whatever. So we'll make that easier for you. And if you get a new loan, you can wait for a while to start paying that back. Then they also said, okay, well, let's offer some distributions. So now, if a plan so allows, and you're somehow affected by the coronavirus, you're able to take $100,000 out of the plan if you have that much money. And then they also expanded the hardship definition to say, well, California, for example, is a disaster area because of coronavirus. Well, if you're in a disaster area and your plan says you can take the money out. So this is all great news. And if you're taking money out of your plan or out of your IRA, the taxation of the money coming out this year is over a 3-year period. So you don't pay all the taxes now. If you take 100,000, you pay a third of it this year, a third of it next year, a third of it the year after. And oh, by the way, if along the way you decide to pay it back, then you get to refile your taxes and not have to actually pay taxes on that money. So it's a really good deal and a great tax planning opportunity for many people. Now, one thing about retirement plans is the IRS eventually wants to get their money. So there's these things called required minimum distributions that are very fact specific, and without because we don't have time to go into it, there's been a lot of changes, and most 2020 distributions, you don't have to take them, and if you take them, you get to treat it as a rollover and put the money back in your retirement plan. There is a retirement crisis in the United States, and one thing about the coronavirus was it meant that interest rates returned to near zero. This is really bad news for a pension plan. In a pension plan, what they do is they know they're going to have to take money out of the pension plan's pocket to pay somebody $100, but they're only going to $80 in the bank, kind of thing. And so what they assume is that there's going to be earnings on money, that they're going to get some reasonable rates of interest and earnings and that kind of thing. And so when the government changes the interest rates to be zero, that exacerbates the problem. Further, when the interest rates are zero, you have to pay out higher benefits to certain people. So therefore, there is a real bad crisis. And in addition to that, the government said, well, if you really had money due here by September 15th, we're going to let you pay it in later on, like all the way to December 31st of 2020. So what happened was this whole funding status of plans fell really drastically. And we get to ignore the normal pension rules, which put bumpers on it to make sure that we don't run out of money in our pension plans. And that's all a political answer to a financial problem. So we're going to see a lot of pension plans going broke this year, and companies struggling to do their funding. You have many plans like truck drivers and electricians and plumbers and all those kinds of plans that unions have and that kind of thing. Those plans are really in trouble. And then our small plan environment, sometimes you're using this year's money to pay last year's contribution. And so that's a really, a real hard problem. So using coronavirus loans and distributions may allow that business to stay afloat and still fund their pension. On the 401k side of the world, we've been begging Congress for extra time to fund our 2019 contributions. They made it easier for us to back out of any commitments for 2020. We're still waiting to hear whether we're going to get any relief for 2019. And so far, I'm not hearing anything in Congress that they're sneaking it into the bill that they're working on right now. Now, for those of you that got a PPP loan, if you haven't done it, you should. Anytime the government offers you free money, or if it's not free, it only costs you 1%, you should say, yes, bring me as much as you like. But you got to use the retirement as part of your payroll expenses for the amount you get. And then if you use part of the money to pay your retirement contributions, you'll get forgiven on it. And one other thing that's going to happen in Congress is that the PPP money meant to be non-taxable by Congress, the IRS found a way around it, and they made it be taxable. So we might see a change there. Remember, there's many deadlines, but the most important ones are if you have a retirement plan, file your return by October 15th and pay in your pension contributions by the time you file your return. So one other quick thing to notice, there is one more deadline, and that's September 30th for all of you that have 100 or more employees. You have if you don't have a retirement plan, then state of California says, we got one for you, and you're required to enroll your participants in it starting on September 30th. So if you don't know about CalSavers, remember the organization that brought you Caltrans and the DMV now wants to run your retirement program, so you should probably call us so that you don't have to have them do it. So that's a September 30th deadline for 100 employees or more. Okay, so remember that Primark is not an 800 number nowhere. We're actually going to help you, and here's my contact information. Thank you so much for your attention.